Hi, this is JP Newman on Investing on Purpose. Today I'm interviewing Mike Brown of Unbreakable Wealth. Mike is a dear friend of mine, and I don't know anyone who does it better than Mike Brown, and not only giving you the exact structure and procedures that you need to create wealth and save wealth, but more importantly, the mindset of how to enjoy your wealth long-term, how you create peace, happiness, so that you go to bed with peace and you wake up happy every day. And Mike does it amazingly well. Enjoy the show. Hi, this is JP Newman on Investing on Purpose. And today I am very, very lucky to have Mike Brown at Mike's house here in Colorado, fabulous Morrison, Colorado. This is my first time at your house, Mike. It's great to be here. We met at Baby Bathwater, which is a phenomenal group of amazing human beings. And Mike, I really didn't know you at all. But first we jumped on a boat together and never thought it would take us as deep as it's taken us.
Here we are.
Even though I'm in Austin and you're in Colorado, we don't get to see each other a lot. I feel like we really are like soul brothers on a lot of levels as far as you've really woke me up to some crazy cool things and just our rich experiences together. We're really transformational. Even how I do business today, you've really coached me as a friend through so many really cool things, and I really thank you for that.
Well, I deeply appreciate it. I'm honored to be on the show. I'm so happy to have you here in my house, and I just love what you're bringing to the world, and so I'm really happy to be a part of it.
Awesome. Well, I just got done from Cloud Camp, and Cloud Camp was a mastermind of 25 people exclusively up at 9,100 feet here. And what was really cool about it was, I was asked to speak about wealth, and usually, Mike, they're asking me to be like, they want to peg me as the cash flow real estate guy. Yeah. But as you know, like there's so much more to finances than just cash flow real estate. It's like one peg, and it's easy to get pegged. And I think what's really interesting, and you're one of the very few people that I've really talked about, and I think that's going to be a great topic for today's show, is like, help us with the big picture. And I've talked to so many wealth managers. They talk about all these topics, but you know what they kind of forget when they talk about these topics? Why are you doing it?
100%.
Right? So the fact that you're a wealth coach, you have an incredible program. I've seen kind of who you're attracting and who you're bringing in, and you are teaching wealth to people and the steps to wealth in a way that will not only generate wealth, but happiness and peace of mind. And no one talks about that. And so I was hoping today, Mike, what we could do is really jump into that topic of really like helping the audience. Like, let's talk about some basic things. Like, I know when I was speaking at Cloud Camp, everybody wants to know about wealth accumulation and wealth preservation and what about loss. And one of the things I talked about is there's preservation, there's accumulation, and then there's mindset. And I say mindset's 50% of it. You and I share this. Just talk more about like, how do you see it? Like, do you see it the same way? Or what's your version of how you kind of see wealth and helping people create it?
Definitely. The first thing I would say is that if information was all that we needed to be wealthy, there'd be a lot more rich people. Yeah. Because there is so much information out there on how to make money, how you should be investing, and no one follows it. No one actually does the things that they're supposed to do with their finances. So there must be a missing piece. Yeah. And you just hit on it. It's mindset. We have these subconscious programs running in the background that keep us from being able to do the things that we want to do and create the life that we want to create. Yeah. So wealth really only serves one purpose. It's to create the life that you want to create. And so every time I talk about wealth, I'm looking at it from the lens of non-traditional wealth, which is freedom of time, freedom of health, freedom of relationships, and ultimately freedom of mind. Because all the money in the world doesn't matter if you're in a prison of your own mind, if you're stressed out, if you're anxious, if you're lying awake in the middle of the night, worried about it. And you can't outrun a poor relationship with money.
Yeah. And by the way, what you're saying is so important. And these are the things that no one talks about. You look on Instagram and everyone looks like they're getting rich and driving their Lamborghinis. And most of those people that you see driving their Lamborghinis and getting rich, they usually crash because they didn't have the proper mindset and structure to protect them. And so how many people have you seen? I mean, Mike, I think you've even had your own story that you share of like people who come up and come down because they didn't understand exactly what you just said.
Yeah. I mean, all of this is born of my own experience, right? So I'm never going to ask anybody to do something that I've not done myself. And so the reason that I created this program and became a coach was because of my own journey of going from rich to broke and back again. And more times than I'd care to admit. Yeah. And I see this familiar story. So I sold my company in 2019 and I thought I'd never be unhappy again.
Yeah. But I remember that I met you right when you're going through the sale. I remember the numbers. We were jumping in the water together surfing and you were telling me your numbers. I'm like, oh my God, that guy just hit it big.
Yeah, absolutely. Yeah. I mean, And I think that, the arc of my life was all kind of marching toward this trajectory. I mean, I wanted to be an entrepreneur since I was 16 years old, and I always dreamed of founding and selling a company. I went to combat. I flew jets in the Navy in Iraq, and I had kind of done all the things I was supposed to do, and there was still this giant hole inside me, right? And basically, I had a terrible relationship with risk, and I had a lot of subconscious patterns driving my investment decisions, and they didn't serve me at all. And 2 years later, I wake up and I am so stressed out and so full of anxiety, I don't want to get out of bed.
So here you are, you had the win of your life. By the way, because I know your numbers, you told me.
Yeah.
People don't only dream of the numbers that you had. So to go from that, where you think all done, home run, you win life, you've won the ticket, and you're mired in anxiety. And what was causing that? What was that about?
Yeah. So, specifically at that time, I bought a distressed e-commerce business. I was losing $100,000 a month and watching my bank account quickly dwindle to zero. And I was building this amazing house, but it was during COVID, cost overruns, lumber, steel, the bills started piling up.
Yeah.
And even though I'm a multimillionaire on paper, I can't access any of my capital because I had been investing in angel deals and private equity deals and startups and all of these other deals for almost a decade. And so I looked very rich, but I didn't feel very rich.
Get it. I totally get that. And I think so many people, especially when you make money, they go right to long-term things that have no cash flow. And that's a whole other thing we could talk about. So all of a sudden your liquidity is gone. And without your liquidity, your net worth, I always say net worth of everything is the least important factor. Your cash flow and your liquidity are your real powerful tools.
Yeah. And I think liquidity is a huge problem in general amongst entrepreneurs because we have this risk on, burn the boats kind of mindset. And my mindset was always, if I lose all my money, I'll just make more.
Yeah.
Right. And so that really works when you're starting a company, when you're going from 0 to 1. But when you're trying to go from 10 to 100, that mentality actually becomes a limitation.
It does.
And that was certainly the case for me.
It does. So tell us more. So by the way, the company was an oil and gas, it wasn't an oil and gas exploration and leasing, if I remember.
So my first company is called Palmares Energy. We were a aggregator of minerals and royalties in the Permian Basin. So basically we would buy deals from 50,000 to 2 million and then package them up and sell them to private equity funds.
Right.
So
and you killed it. I remember your run. I mean, you were telling me your numbers.
Yeah, we had an 8-figure exit, built an 8-figure portfolio for ourselves, and was really an amazing experience. And the irony is that my job was building a balanced, risk-adjusted portfolio, and I did that on a really, really high level for my company,
right?
And I wasn't able to do the same thing with my personal finances.
I understand.
And so as I'm diving into this, I'm going like, wait a minute, like what is getting lost in translation? Why can I do this on a professional level, but I can't do it on a personal level? And that's where this mindset stuff started to kind of come to light and go, wait a minute, I know the right things to do. Like I know I am writing checks that I shouldn't be. I'm investing my last $250,000 into some startup deal when I have zero liquidity, and if this doesn't work out, like I'm starting back to square one. Like, why am I making those decisions? So that's what I really had to dive into to understand and get to the next level.
So why were you making those decisions?
Yeah. So,
it's so to be this self-aware. By the way, this could save you guys a lot of heartache because you work years to build your company and you don't even know what you don't know. You make a good point, and you can lose it like that if you don't have these from the beginning when you start a business to know these structures now. So like what happened? Like what were the thoughts that were the things that were keeping you?
Yeah. So, two kind of driving factors. One is from a neuroscience perspective, and the other is from a childhood pattern perspective. So I'll start with the neuroscience. When we look at the neuroscience of risk, basically what happens is when we take a risk, say I invest $10,000 in something and I get $20,000 back, my brain releases dopamine, serotonin, and other endorphins. It gives us this sense of safety and well-being. Mm-hmm. The problem comes that next time you have to invest twice as much and make twice as much just to get to the same level of well-being and safety and satisfaction.
I see the slippery slope there.
So that's called hedonic adaptation. And basically I was addicted to the cycle of risk. So I was, the problem is not ever that I haven't been a good investor. The problem is that I've been too risk on. And so I am.
Which is really common, by the way, super common, especially as an entrepreneur, a young entrepreneur. You have some exit and you don't even realize the risks. Can't even measure in your brain the risk that you're actually taking.
Totally. So, starting in 2014, we invested probably $2 million into angel deals between 2014 and 2017. The irony is that I already had a vehicle to beat the market. My company, if I had kept that $2 million in my company, that would have been worth $10 million at my exit.
Wow.
But instead, I've got this $2 million portfolio. And look, some of the deals failed. Some of them are doing just fine. Some of them knocked it out of the park. It's certainly not worth $10 million,
right?
Except for now I was distracting myself from my primary business, doing due diligence, playing in an arena that I didn't have a deep expertise in. Yeah. And there's so many reasons. First of all, ego is a huge part of it. It feels really good to be the guy that people come to when they're starting a new company.
I get it. Yeah, I totally get it.
Totally. And two, I think we have this hero culture around VC. So we look at people like Tim Ferriss and Mark Andreessen and we go, oh, Tim Ferriss made $100 million in Uber or whatever it was. And you go, that must be the way to make money. So when you're an entrepreneur and you have an exit, that must be what you do next.
Right.
And the fact is, what we don't understand is those people are actually investing a very small portion of their portfolio.
Right.
They've actually got safety and liquidity
tied
up. And, so a family office who's doing VC deals probably is only doing 10% of their entire portfolio into VC deals.
Yeah.
I'm doing 100% of my portfolio into VC deals because I see these people that are my heroes making those kinds of, investments. And so I think that's what I'm supposed to be doing.
Interesting. Just at this bathwater that I spoke at, I have a really simple strategy, which it's always been in my head. I actually explain to people. I actually have 5 buckets. And I every time I do an investment, I give it a risk rating between 1 and 5. 1 being the safest. 1 would be like treasuries or just cash management tools, things that are easily liquid. Then there 2 is you can imagine it's a scale. 5 is going to be what you'd call your real speculative kind of stuff. In my portfolio, because I went through my portfolio before I did the presentation, 70% of my investments fall between buckets 1 and 2. They're either cash flow or they're cash flow like my debt fund that pays 9.5. It's that's 70%. There's probably, call it the 20% is what I call moderate risk, development, back to your point, no money, no cash flow for a bunch of years. And you hope all these risks you're taking on that you don't know, interest rates, construction costs, all those things like you on the house, that's 20% because some of it's sexy and some of it can have outsized returns. 5% of what I do, Mike, is what you'd call category 5 of risk, which would look like Series A, angel investing. And I always say lending money to a friend. That's also category 5.
Yeah, totally. And I think the big difference to note on your category 1 through 4 is none of those can go to zero.
Right.
They might result in a loss,
right,
but they're not going to go to zero because they have assets. They're backed by assets.
Correct.
When you make an angel investment, there's actually a strong chance that that's going to zero.
Exactly. And then to make that up, if you just do your time value and money, making up that loss, no matter what you're making, you're spending so much energy and time, like you said, mental energy, and also just do the math. When you lose all your principal or 60% of your principal, it takes a long time to make that back up again.
Yeah. So I've actually just run out all the math. And what's really interesting is if you invest $1 million in, say, an S&P 500 index fund that yields 6% over the life, over 60 years, you end up with about $30 million. If you invest that $1 million into startups, and let's say that you match the market and you have a 7% return, but every 5th year you have a 20% drawdown, you only have $800,000 at the end of 60 years.
Wow.
So if you have a 20% drawdown every 5 years over the life of that portfolio, you actually have less than you started with.
Explain the drawdown. It's like a 20% loss when you say drawdown?
Yeah, exactly. Yeah. So if you made a big investment and one of those companies goes bankrupt in your portfolio, which is exactly what happens. It's actually how those funds are designed to work. They know that they're going to weather losses.
Yeah.
Now here's something.
It's a hits-driven business. You're hoping that you make 20 investments and 2 of them hits 20x to wipe out the losses you're going to get from the next 8.
Absolutely. Here's something even wilder. Let's say you are an incredible angel investor and you average 20% returns over that time, but then have a 20% drawdown every 5th year. You only have $18 million at the end of 60 years compared to the $32 million that
if you just would have kept it in the S&P index.
Absolutely.
Yeah.
So you might think that now I'm just recommending that everyone only invests in the S&P, which is what a lot of, Ray Dalio and Warren Buffett and Morgan Housel and the Psychology of Money, a lot of people recommend that. I actually do think there's a better way. I think that's an important part. It's the base of a portfolio, but I don't think that's the only way. But I think when we start peeling back the onion, we realize that like, hey, this is probably not actually where most millionaires should be spending their money. Billionaires, now they have a concentration risk problem and they can't put any more money in the S&P. They need to go out and create diversity.
Right.
That's not my problem.
Right. I agree. For most of us, that's not our problem.
Exactly.
Agreed. Mike, you said something, I think people don't talk about this, and you said it twice, and I think it's really an important thing. You said, hey, if I did this investment in the index and I could get 7% back, it would be this number. That's my reinvestment rate. And I think it's one of the things I speak about, which it's amazing to me that a lot of people don't know this, is that when you look at your, even if you're starting out, I don't care if you're making your first $100,000 or if you're managing millions of dollars, once you kind of know, we're going to talk about purpose. Once you know your purpose and you roadmap it out, and if you are an entrepreneur, ways to make money, your reinvestment rate, in your case, you said that if I can make 7% a year for 20 years, look how that's $32 million.
Yeah.
What people also, I think, get wrong a lot of the time, my personal reinvestment rate across my portfolio, Mike, is 8%. You know why? Because I've got this real estate business over here, and I have a chance in my business as an entrepreneur. My doubles, my triples, and my home runs are in my home business, and I need to focus on them, right?
Absolutely.
And then all I need to do on this other side is not lose my money, because it's so, what we talked about, when you lose your money, it takes so long to make it back. So if I can just if I'm making 5% at the bank right now, and I can make a couple, 2-3 risk, moderate things where it's paying me 12%, and I've got to 8%, I win the game.
That's all you need.
That's all I need. It's actually so simple. We get so to your point, we get so struck with these sexy tech things. And again, 5%, I love supporting friends that are doing cool things that can change the planet, or I just believe in them. I bet on the jockey. Half the time I couldn't tell you I fully understand their business plans. You can read it, but the truth is you're taking risk, and it's okay to take a little risk.
Yeah.
I like less than 5%.
Yeah. The way I think about this is that as an entrepreneur, if you have a primary business that is growing, you already have a vehicle to beat the market. You already have a vehicle to create those outsized returns. So every dollar that you take from that primary business should be used to do one thing: hedge risk.
Interesting.
Because now, if you've built a liquidity war chest, if you have a real estate portfolio on the side, those are actually the legs of the triangle that support the primary business. And I actually want to be reinvesting as many of my dollars as I can to grow my primary business.
Protect your engine, your company, the very thing that helps you.
Totally.
Create passive cash flow, income, and everything that we always tell you is the winning game, cash flow.
Yeah. And the thing is, distraction is the greatest destroyer of wealth.
Wow.
And on the flip side,
that's really important. Let's just take a minute on that. Distraction is the greatest destroyer of wealth.
100%.
That's a gem, because I don't think anyone would actually think of that intuitively. And I think you're absolutely right.
So what I tell entrepreneurs is, if their primary business is growing, they have a reliable way to beat the market. The best thing they can do for themselves is get so good at that primary business that they are bored to tears, that it's difficult to get up in the morning because you are so bored, because your processes are so dialed, your cash flow is so dialed. Everything is so dialed in that primary business that it's difficult to even get out of bed to work on that thing.
It's so boring.
At that point...
sounds great.
Yeah, at that point, you are on the verge of true wealth. Yeah. But what we do is we get bored and we go out and go, well, actually, I'm going to be an angel investor on the side. Right. I need to build a cash flowing real estate portfolio like JP. And now I'm taking valuable hours from my primary business. Right. I'm going over to an area that I'm not an expert in. Number one is, I have to put in the time to learn that new thing. If I don't, I'm going to lose a bunch of money, and I'll probably lose a bunch of money anyway on that learning curve. Yeah. And then number two is, we think that what other people are doing is so much better than the thing that we're doing, because we know the ins and outs of our primary business. It's hard. And when we actually go into these new businesses, we find out, oh shit, the grass isn't greener necessarily.
Right. It's like FOMO, like on Instagram. Everyone's in Ibiza or everyone's doing something, but it's got to be better than what I'm doing, right?
Yeah, absolutely. And this is, exactly what happened to me with e-commerce. I was in baby bathwater. I saw all these people crushing it in e-commerce. I was in boring old oil and gas.
I'm in boring real estate. I felt the same way you did. I was like,
that's not cool at all. Let me go buy an e-commerce business. Oh shit. E-commerce is hard. I'm managing inventory. I'm managing like 7 different marketing channels. I'm managing a warehouse. Like, this is a very difficult business. And God bless anybody in e-commerce right now, because there's a lot of headwinds. That's a very tough business. And I paid a steep price for my learning curve.
Yeah. You know, Mike, I'm going to share also, which is an interesting angle to what you said. I can tell you, for me, when I got bored in my real estate business, I started doing other projects. Like, I made my money being really good at workforce housing apartments. People paying rents between $1,000 and $1,800. That's been my bread and butter, and I was killing it. But I got bored and thought, get overconfident. So I started buying senior projects. I started diversifying, getting out of my lane. And by the way, there's a lot of apartments in America. There's a 6 million unit shortage between supply and demand. And I happen to live in Texas. I've got 21 million people within 3 hours of me with diversified economies, 4 diversified economies. I could go nowhere for the rest of my life and have, but again, it was that distraction. It's exactly what you said. I got distracted. If I was to tell you, it wasn't just I lost money on these projects. If I was to tell you the number of hours I've had to spend managing versus the apartments that are just making money for me and my investors, those are cake. I mean, I'm spending 80% of my energy managing problems. So if 90% of your portfolio is great and you get distracted and you start doing this stuff, you're going to wind up spending 80% of your energy on the 10% that you could have been doing so much, to your point, making so much more money by just focusing on your primary business. So not only is it like, keep your mind on your business, if your business is working and you've got some great core products, if you want to experiment a little bit, but just remember, if it doesn't go right and you don't think about this ahead of time, it took so many resources out of my primary business that I'm sure was lost opportunity. And I think it's a great lesson, whether it's in your company or outside of your company.
Well, and the biggest thing is the financial loss that I took on the e-commerce company wasn't the worst part. It was all of a sudden my freedom of time, my freedom of mind. I'm stressed, like
sleepless nights.
Absolutely. So, So 2 years after I sell my company, I am now, up in the middle of the night in cold sweats. And that was a much worse outcome than losing money. I'm okay with losing money. I'm not okay with losing my freedom of time and inviting this massive stress into my life. It puts strain on my relationships with my spouse, my family, my friend. I had friends invest in the deal. Yeah. Now I feel terrible about that.
Yeah, totally.
And it really all comes back to this distraction. Like, I had a reliable vehicle already. I didn't need a new one.
No. I always say, like, when you actually, if you're lucky enough as an entrepreneur to create a business that works, honor your engine. Just honor that engine. Like, that. Because it's so easy to say, I'm bored. I've made, what do I do? And it's like, oh my God, like honor that engine and keep it and like revel in what it's done for you and protect it and shine it and just know its value and try not to get distracted.
That's it. I mean, and fall in love with parts of that primary business. Right. Like, I wasn't passionate about oil and gas. It's not something that I particularly care about, but I was passionate about deal making. So what part of your business can you fall in love with where the widget that you're selling doesn't actually matter? And I think one of the things
I love that, by the way, and a lot of the social impact that you and I share, like values of creating, impact through business. I think it's a lot of that fuel is it's not necessarily real estate. I wasn't born to be a real estate investor. I don't think God put me on this planet and said, he will be a real estate investor.
Totally.
But you use your own mind and you manifest the most interesting parts that get you up in the morning.
Yeah, absolutely. And then so just ruthlessly eliminating distraction and then creating a set of like an investment thesis. Like you said, I invest only in apartments that yield this much, right. Like the stronger your investment thesis and the more rules you have around it, the better you protect yourself against going and incurring losses in a new arena.
And I think I'm really, my own lesson has been to write down and have a little more structure and some your own gut things in your personal finances and in your corporate, like your business thing, like you said, rules. And I'm realizing, and I think it was really a good takeaway. And you're doing a great job of teaching people. If you don't know your rules, if I say, Mike, I actually right now, Mike, if you wanted to talk off camera, I've got 3 deals I could tell you about. I could tell you about the solar deal that I'm really excited about, this opportunity zone. Like I got 3 things and they're always going to be shiny because the first day of any deal, it's like the first day of a date. It's always good the first day. And this business plan is perfect the first day until it's not on the second day because things change. And so that all that glitters is not gold, kind of mentality of if you don't have a checklist, even like if your barrels, like if I know that 70% of my money is between 1 and 3, and you bring me 3 deals, Mike, and you say, these are great deals, but they're all in buckets 4 and 5, it gives me some framework to say, those are interesting, but right now my bucket 5, like it's already full, or I just did 2 of those, and it gives me, for me personally, it gives me a framework to really quickly, rather than go through the toil, because stories are sexy. Business can be very sexy.
And making money is sexy.
And making money, the thought of making money, that dopamine hit you're talking about, the serotonin hit. So for me, just having a backstop, and by the way, having a backstop takes some effort. It's taken me 7 years of failed software programs, financial advisors promising me they would manage my money and report it, and they never did. I've had to go to hire a personal CFO who uses a good old Excel spreadsheet, and every quarter we meet and look at my returns. So reporting and tracking is key, because if you have a structure but you're not keeping track of your distributions or how you're investing and kind of keeping those categories together, you really don't know what you have. When you have that information, it is power, because now when people pitch me things, I can so quickly not have to emotionally toil about them. I kind of know what to do.
I'm all full up. Sorry.
Yeah.
This is the answer. You might have, and I've got a story that really kind of pulled back the curtain for me and was like a big aha moment. Is after I sold my company, next thing I decided to do, I was going to raise a VC fund. I was going to go out and actually raise an impact VC fund.
Cool.
It's a very sexy thing to do. And I started going to family offices, and I went to one family office who was a very good friend, and pitched him the whole deal. And he said, Mike, this is amazing. Like, I am so proud of you. This is going to be the biggest thing, and it's really, really cool, but I can't invest. And I was like, why? Like, I thought you would be my anchor investor.
Right.
And he said, our rule is that we don't invest in first-time fund managers.
Wow.
So I was like, well, why not? And he was like, hey, I actually think you're going to knock it out of the park. I think your fund is probably going to have crazy returns, and we're going to be sad we missed it. But we would rather miss out on epic returns and keep our money safe, because our number one rule at this family office is we don't lose money.
I love it. That's so great, because we don't lose money.
Yeah.
Because if you don't lose money, you have such a great example, Mike. If you don't lose money, how much can you make by not losing that 20% pullback, that drawdown you were talking about? Mike, let me ask you a question. There's a lot of people in my audience that are younger. They're just starting businesses. They may say, great, Mike Brown, you've got all this great advice for entrepreneurs who have made 10, 20, 30 million or 5 million or whatever. Yeah. What about for the person who's just kind of coming up and they're starting a business, or maybe they even just work for an employee and they dream of like a better way to manage their money? Like, what advice would you give them? Yeah.
So the number one thing is invest in yourself. I think we do people a disservice by telling young people that they need to follow their passion. I think the advice should actually be find a skill and become passionate about honing your craft. So the best thing you can do on your way up is becoming world-class at one thing, and then you can get into the place we just talked about of rinse and repeat and don't get distracted. But you need to build that world-class skill at something first. Yeah. So that's the number one piece of advice I have for anybody. And then the number two piece is that the power of compounding doesn't just work in investing, it also works in personal habits and discipline. So if you get up and you just dedicate, an hour a day to honing that craft, education, reading every book you can, whatever it is, developing that skill, the compound effects are incredible. And you're going to look up in 5 years and you're going to be the best in the world at this thing because you were continually getting better and putting in the effort every single day.
It's funny, Mike, you say that, because like that whole thing about 10,000 hours, like that Bruce Lee or that proverb about 10,000 hours, it is strange because at this point, like people were rifling questions at me, this like crazy questions from everyone. I can answer each one of them, not because like it's just been years of practicing a craft and working really hard, where now it's effortless. It's like the black belt, right? You actually get to the point where but it took years. What looks really easy has taken years of wins and losses and, things like that. You mentioned something I want to go back to because I think it's important. It's a very Western notion about follow your passion and follow your heart. And, I even talk about on my podcast, knowing your why. Like, what is your legacy? Like, what is it that drives you? And I like what you said. It's kind of interesting. You're like, that's nice, but also like, what are you actually good at? And I think that's a really good point. But I know you also believe in like following something that your deep north compass of actually call it your God-given talent or something that's so like, explain that to me. How do you justify or like calculate that?
Yeah. So David Brooks has an incredible book called The Second Mountain. And basically the analogy is that most of us build our first businesses from a place of ego, from a place of necessity, from trying to come up in the world. And it's probably not something that you're incredibly passionate about. And then there's some kind of event, either an exit or a near-death experience or some kind of catalyst to go, hey, actually, what I've been building here probably wasn't the thing that I wanted to build. And now the second mountain is going out and building something that does drive this kind of impact. And I actually think it's a privilege to be able to be on the second mountain and come back. And now I'm optimizing my business for completely different things.
I love it.
Right. But I have the foundation, like you said, and this is, I don't want to be negative about anybody, but like, this is why I don't think you can really be a 25-year-old life coach. Like you don't have the experience to be able to share your wisdom yet because you haven't earned any wisdom.
Right.
And so, what I look at now, and I used to tell people that the concept of ikigai was bullshit, and you probably shouldn't follow that, which is basically a series of concentric circles in a Venn diagram, which is what you're good at, what the world needs, what you love, and what makes money. And if you can live in the center of that, that's this concept of ikigai. And now I had to rethink the idea that that's bullshit because I'm living that today. But it came organically. It came because of the blood, sweat, and tears. And another concept that is in the second mountain book is that from pain comes wisdom, and then the third phase of that loop is service. Mm. And so who am I if I've gone through all this pain and I've gained all of this wisdom? The natural next evolution of that piece is service, and that's where you can kind of get into that ikigai concept. And so now I'm making money, I'm growing a business, but I'm also leaping out of bed every morning because I care so much about what I do, and I'm so passionate about helping the people that I serve shortcut my mistakes and avoid some of the pain that I went through.
I totally get it.
And pass that knowledge on, right? And so that's what's incredibly important to me now, but I had to earn it.
I totally get that. And I actually feel like you do. I feel like after years of being presented by financial managers, wealth managers, registered investment advisors, like I've heard it all, I'm amazing how low the bar is for financial literacy, period. Rich Dad, Poor Dad, Robert had a good point. Like, if you didn't learn it from your dad, you're not learning it in school. I see what my kids learn in high school. There's no financial literacy there. So if you're not learning it from your dad, or if you're not learning it from elsewhere, you really don't have a lot of framework. And then ironically, when you think you've made it and you've got these financial planners, well, we all both know that 95% of them have gone to the same school. Yep. That's 30 years old, the playbook. And the playbook was written by Wall Street in terms of 401ks and all. It was written by the people that it's like going to Vegas and thinking you're really going to beat the house long term. And that's not the way the system was built.
JP, I'm so glad you brought this up, because when I talk to entrepreneurs, when they come to me, the number one reason that they don't feel like they have control of their finances is because it's overwhelming. It's because there are so many things being pushed to them that they don't even know where to start. So what do? They do nothing because it's too overwhelming to even get started.
Just almost hide. And
there's a reason for that. Is because this financial industry of all of these financial advisors, planners, RFPs, they actually feed on fear. So when you talk to one of them, they're going to make it sound so complicated. That way you have to hand your money to them and they're going to make their fees. But if you're paying 1% in fees over a 60-year portfolio, you lose 28% of your returns just to fees. So the cost of having someone else do your finances is 28% over your lifetime.
Yeah.
Okay. But they want to make it complicated in order to make you scared and hand over your money.
Right.
So I have a rule. I'm never going to hand money over to a financial advisor that isn't wealthier than me.
Totally.
That doesn't make sense.
I'm actually interviewing right now wealth managers. And if they're not managing family offices, I'm not interested. And like most of them can't wow me. I'm like, you have to present to me something, because everyone's presenting the same basic deals. Yep. They're just going to the equity markets, the stock market, and they're doing this. Is there anything else, Mike? We were going down the road a little bit of like for people who are really starting out, like in your coaching. And I want to get a little deeper in your coaching, your program, if you can. But before we go there, just like if there was anyone in the audience that's younger, because it can be overwhelming. Like we're talking about some pretty sophisticated things that we've done over the years.
Absolutely.
What's like if you're talking to an earlier client, like what would be your 3 or 4 best points that you give them?
Yeah, I mean, one of the first things is it doesn't have to be hard. So take all this complicated stuff and throw it out the window. Focus on building that skill. Focus on building your primary business and beating the market with that. And then any dollar that you start to take out of that primary business, just put it into something safe. And that could be the S&P 500 index fund. That could be residential real estate if you have a very tight box of exactly what you're going to do, but don't distract yourself with trying to be in 57 different types of investments.
Right.
Just take money out of the primary business and put it into the same thing over and over and over, and don't get distracted. Right. So
I love that.
You hear this.
That's a really important thing. I think you think, because all these people are brainwashing you. Diversification, Mike. What does that mean, diversification? Do 2 or 3 things that you actually know. Because the truth, like you said, we don't know. What do you know about healthcare when they put you in a CVS stock or something? Like, we don't know. You can read the 180 pages. You don't know. And I love the idea of keep it simple and keep it with things you know that you actually are interested in. Like for me, as a real estate guy, when people ask me this question, it got asked again this week by 5 people that came up to me. What should I do? I've saved $20,000. What can I do? I said, save it. Keep it at 5.5% for a while. And if you need a house, I love a house. Why don't you buy a house with that? And that's your down payment. And then maybe you can rent out the garage and you can have your first experience of like, you're creating equity, pay that down. Because I come from a real estate bias, and that's what I always dreamt of, for me.
Totally. Well, and the other thing is, like I said earlier, most entrepreneurs don't have enough liquidity. So if you don't have 12 months of living expenses and 6 months of business operating expenses in something that's completely liquid, and by liquid, I mean something you can access in 24 hours. So I actually consider the S&P index fund as liquidity.
Yeah, me too.
You can store it there, but in a case of emergency, you have this fund. And if you don't have those things, if you don't have 12 months of living expenses and 6 months of business operating expenses, you don't have enough liquidity to start going investing in anything else, including real estate, in my opinion.
Correct.
And then if I'm going to invest in real estate, I actually want to bump up my liquidity by 12 months payments on that note.
Yeah, agreed. By the way, I had a couple wealthier people ask me, what should my liquidity be? These are people who are very well established. And I said, my general rule is actually 4 years worth. But that's a luxury. You can't do that in the beginning. But as you get wealthier, when you have more to lose and you've got family, my general rule is no less than four times my burn rate, meaning that I could go for 4 years. If things got really screwy, I could go for 4 years in liquidity between, again, it's not like it's all in cash, but it's in things that can be converted to cash quickly.
Yeah, I actually think about it in a similar way, but I actually just want to grow my liquidity alongside any other buckets in my portfolio.
Totally.
So if I'm growing my real estate portfolio, I want to grow my liquidity at the same rate.
Completely.
So how much should my liquidity be? It should be the same percentage as anything else in my portfolio.
I agree. Yeah.
Right?
Yeah.
But
since I've lent over $500 million in loans, I've seen a lot of people's financials through the years. I'm always amazed at the guys who stayed in net worth, which you and I both agree is the least important. $20 million net worth, $40 million net worth, and their liquidity is like less than $1 million. I'm like, you say on paper you're worth $40 million theoretically, and you've got $400,000 of cash and like not a lot of liquidity. I don't understand that. And I see it more often than, I'd say it's 80% of what I see. 20% of the people actually have what we're talking about, like proper levels of liquidity.
Yeah.
Most do not.
Yeah.
Which
Absolutely.
I don't understand. Because they tell you it's leverage your money.
Yeah.
Your money can't sleep at 5%. You can leverage it, and that's how you make millions. Right?
Oh yeah, look, one of the greatest lies ever told, like inflation is eating your cash.
Right.
Inflation's not doing anything to your cash, right? Like you know what eats your cash faster than inflation is losing money in VC deals, right? Like it's perfectly okay. So this is another thing I do is I give people that I work with permission to not optimize. So if it makes you feel better to have $250,000 in a savings account, and that's what makes you sleep at night, that's great. You don't need to go take it and put it in a high yield. You don't have to do anything with it.
Right.
We're told, again, by these financial advisors that we need to optimize every dollar. We don't have to. It's actually okay to keep things in places that don't necessarily make the highest return, but they serve some purpose to us.
Right. But I've been doing that for years, Mike, and I always get criticized for that because JP, your cash is, why aren't you maximizing your life insurance credit out? Because I don't want to pay 7%. I've got the cash. Why would I do that? It actually psychologically pulls for me that I'm making payments when I don't need to be. Why would I want to leverage my life like that? But I'm always told I'm doing it wrong mathematically.
Yeah, well, that's probably from someone looking to earn fees.
Right. It is actually, by the way.
Yeah, totally. That's... when you look at, when you follow the money, you understand why these people create fear that you don't know what you're doing.
Yeah.
But you absolutely know what you're doing.
It's been a gut thing, and I'm always taking bullets for it, but it's been my instinct. So.
Well, and so here's the final piece, and I think this is where I really want to get to with this conversation is the reason that we don't need to beat the market is because you need to use our wealth to build the life that we desire. And once we've hit that point, we actually don't need to go and invest in all of these things because investments should only serve our values to create the life that we want to create.
Wow. You don't hear that very often.
Totally. We have this idea that you have to just get more and more and more and more, and that more net worth is better. And look, I challenge people to try and push themselves and become the highest version of themselves, and net worth's going to follow that. But it's actually opposite of the reason most people think we create wealth.
I think you're absolutely right. And it's a lot of times I can even see it. And sometimes I have to even like check myself. It's like, oh, I've done X. Now let me do 2X. But why? Well, why?
Yeah.
Is it ego? Is it vanity? Do I really need it? Does my lifestyle change at this point? Like, what do you want that you don't have? Do you want a boat? You want a yacht?
It's one of my favorite coaching questions.
Right.
What is it that you want that you don't have now?
Yeah.
If somebody says a vacation house in the mountains, okay, cool. Let's figure out a plan to get that. Now what next? Do you want a second one? Why?
Right.
Like at some point, there's diminishing marginal utility on having more stuff.
Right.
So if you kind of maximize your stuff budget, and again, you can build a really incredible life on a lot less money than people think.
Oh, I think a lot of people, you could actually be quite wealthy. And this is a big number for a lot of people. But and Tom Wheelwright, actually, this came from Tom Wheelwright, $250,000 a year, which is a big number. I'm not saying it's not, but you can live quite a wealthy lifestyle on $250,000 a year, which again might seem like a really big number to you now, but you'd be surprised in 5 or 10 years of hard work that you could be wealthy very quickly. And I think people, but again, you're watching Instagram and TikTok and you see these guys and they're throwing out these sports contract, these football players are making 40 million. And it's like, oh, like that seems easy. He made 40 million a year. What am I doing wrong?
Yeah.
These are like these are like the stories that tickle our brain but they're not really reality for the rest of us mere mortals.
Totally. And when you talk about, $250K, the number I actually use is $30,000 a month. So like $360,000.
Isn't that funny how close we are?
Yeah.
And yours could be adjusted for inflation.
Yeah. Yeah, there you go. But like you can do almost everything that you want to do except for fly private. If you want to fly private, you need about another $300,000 in order to do that. But now you're only at $750.
Oh, totally.
And it's very difficult to spend a whole lot more money than that unless you're collecting stuff or spending on ludicrous luxuries like a box at the Super Bowl. But as long as you don't have an affinity for those things.
Or large yachts.
Right.
Or a proclivity to get divorced a lot where you keep splitting up your money.
Yes.
Those are all the traps that'll eat you.
0 out of 10 recommend for wealth preservation is going through a divorce.
Mike, tell me a little bit more because I know we're kind of running out of time here. I want to tell me more about your program. Tell me the name. How can people find out more about it?
Yeah.
Give them a basic idea of what this is. And if they want to reach out to you, how would they reach out to you about your program?
Yeah, so Unbreakable Wealth is a program I developed specifically, again, to heal myself 5 years ago. I basically thought through like, what would I need 5 years ago to keep me from the mistakes that I made? And that's kind of the genesis of this program. So, up to this point, it's been retreats hosted here at this house. I've done 4 so far. And then the other way you can work with me is via private coaching. I've got some really exciting things in the works, looking to scale this and launch.
Who's a good client for you? Like, who would really, do you think would get the most value from your program?
Yeah. So basically, the client avatar is someone who is starting to take investable money outside of their primary business. So that typically looks like somebody starting to pass $250,000, $300,000 a year, and net worth crossing that $1 or $2 million mark. Like that's really kind of the lowest end that people could really benefit from all of the strategies. And it's a 3-step process. So the first step is understand our money stories. Because like I said at the beginning, there must be subconscious patterns that are limiting us from keeping us from doing the things that we know we need to do.
Yeah.
So we deep dive our money stories, learn about where our beliefs for money came from and how they're keeping us stuck. And then once we've done that, we create a portfolio plan, a wealth plan that serves our values. So we have to understand what our values are. And then we have to create a wealth plan that actually serves those values. So creates that ideal life that we're talking about. Yeah. And then the third part of it is pure accountability. One of the biggest problems in finance is that we're not supposed to talk about money at the dinner table.
Right.
And everyone's nervous to say what their net worth is and how much money they have in the bank. And what that does is it allows us to act in secrecy. So when I think back to some of my worst money mistakes ever, if I had to spread my portfolio out and justify to you why I was writing a check into this deal, you would have said, Mike, that's crazy. Like that is way too much relative to your net worth to be risking on this deal. So what did I do? I did it in secrecy because I didn't want to have to justify it to anybody else.
Right.
And so I create pure accountability so that we can, lay our portfolios out and everybody look and go, hey, I'm about to make this investment decision.
Yeah.
And your peers are not there to tell you whether it's a good investment or not. They're just there to say, hey, does this fall in line with the goals that you set out for us?
Yeah.
So they're there to keep you accountable to your own plan.
Putting bumpers on it. Mike, I have to say, is that the basic?
Yeah, that's the basic program. So, if you want to check it out, go to unbreakablewealth.co. And you can sign up for the newsletter. There'll be information coming out about the next cohort that's starting up this fall. So we'd certainly love to have you if any of this resonates.
It's great. Mike, what you're offering is not out there. And I'm so happy listening to you because I passionately share this idea. You're weaving in concepts that you will not get anywhere else. This idea of really knowing what you're after. And the way I've been saying it for a while now is actually when you make it, who cares? Like, what was the money for? And it's to wake up happy and go to sleep with peace. And what happens when you can do that? When you have your structures in place, then you can really manifest, right? You can really do impact for your communities. You can really be that great father that's not stressed at night because your energy's been drained. You can be that great community leader. You can be that, you can learn how to now take that manifestation. I know I'm going through it. You're going through it. Like, how can I manifest a nonprofit right now? Well, that's a whole different challenge. I want to be on board of advisor of an environmental, I'm doing all these fun things now, but think about this, Mike. I'm in the middle of a downturn and I am having some problems with real estate. I got a lot of things working, but I have some things that aren't working right now.
Totally.
I've built this structure over years. I built a fortress over years, and it's been mindset, exactly what you're talking about. Without it, I would just be sleepless nights. It's not that I don't care. It's not that I don't worry. And it's not that I don't have to work on my business, but I have so much capacity because my structures are in place that I have capacity. I'm already thinking about raising money for the next cycle. I'm already I get to be in my highest thing, which is I'm a creator. My other partners are running the business. They're doing a great job.
Totally.
Managing, I would say, managing all the properties, doing everything we can in our power to make sure we're doing best serving those investors. But because these structures are in place, I get to do my highest right now, which is build. So what you're saying here is, I just want to I can say to the audience, you're not going to hear this anywhere else. I've spent hundreds and hundreds and thousands of hours. I've met with so many financial planners, both personally and as potential investors, and they don't talk in this language. So thank you for taking the time to do this. B, guys, I think you really fell in luck because you're not going to hear this from go surf 100,000 podcasts and you won't hear what you just heard today. So Mike, thank you again so much for sharing. I'm just so excited for you. And I hope you and I can jam because you might be the only person I know that actually thinks like me when it comes to money. And I just love that.
Yeah, this has been an incredible conversation. And we went into some things that I don't often talk about on podcasts because we have such a shared value system. So it's been really cool.
Awesome. Thank you so much, Mike.
Thanks, JP. Appreciate it.